Hi, I'm Hamilton Alogaga. I'm an ACCA-qualified accountant specialising in financial performance reporting and financial planning and analysis, typically short into FP&A. Your company is on the search for an FP&A professional. You may be the CFO, the CEO, a founder, co-founder, or recruiter on behalf of one of these, meaning you're likely searching for an FP&A professional because you need someone to provide deep insights into the performance story, the position story, and the cash story. Whether that is analyzing the past by the actuals or projecting the future through the quarterly forecast, annual budget, and 5-year plan, irrespective of scale, ownership, or complexity, the deliverables remain the same. My career has centered on building structured driver-based FP&A functions in growth, private equity-backed environment through to large multinational PLCs. I focus on establishing forecasting discipline, cash visibility, and integrated reporting frameworks that provide sponsors with decision-grade insight. And in these environments, my starting point is always consistent. I establish forecasting discipline through driver-based model that reconcile operational drivers to EBITDA and cash. Once the structural clarity exists, the team, the reporting cadence, then and only then the governance framework can then be built around that foundation. Here's the thing. Not every FP&A methodology works for every company. I get that. However, hands-on experience has shown that reporting on top of instability only creates more chaos and more of the same non-desired outcomes. On the flip side, I've found that value is mutually delivered when working with sponsors who want to solve the underlying instability rather than just layering more on top of that which was already failing. As a result, my mandate is to help sponsors institutionalize their function from the ground up, ensuring the foundation is as solid as the insights. Together, we then build something that's truly institutional, and that's exactly the type of environment where I operate. It is therefore fitting that I show you just what my FP&A encompasses. Using the latest version of the Java-based nested suite of fully integrated models, we'll focus on the executive overview page of the management reporting package. Here, the 3 principal financial statements are presented in alignment with the double entry foundation and articulated according to their economic essence. Starting with performance. This is how the organization earned, spent, and complied. Traditionally known as the profit and loss or income and expenditure statement, this narrative presents performance across defined period through 4 structured layers. Using the example of a resource in professional services stream, we can trace the logic. Here we see the generated income, being what the organization brought in through its core activities. Next up, you see the direct cost, the immediate traceable costs such as that of the resource's salary, and indirect costs required to deliver that outcome. And then the supporting cost, operating expenses required to sustain the organization but not directly tied to revenue production. And that leaves us now with statutory costs, taxes, and other monetary obligations. Together, these layers reveal whether economic value was created during the period. These are prepared on an accrual basis. This statement reflects economic activity, not cash timing. Next, we'll look at the position, what the organization owns, owes, and what remains. Traditionally known as the balance sheet or statement of financial position, this captures the organization's status at a specific point in time. Using the example of a loan taken to acquire an asset, we see the resulting posture. We start with what is owned. Assets. Resources controlled by the organization, including the new ones. And then what is owed. Liabilities, obligations the organization must settle, including the loan we just took. Now we're left with what remains. Equity, net asset, the residual interest belonging to the owners. While the first 2 statements reflect performance over a period, this one reflects accumulated structure at a specific date. It represents financial posture rather than liquidity. That takes us neatly to the third one, which is liquidity, where the cash came from and where the cash went. Traditionally known as the cash flow statement, this focuses exclusively on liquidity. Following from the earlier entries, we see the actual movement of cash structured into 3 categories. The first one cash from operating activities being cash generated or consumed by day-to-day operations. Takes us to the next one, investing activities, cash deployed into the realized from long-term assets, including the cash outflow for the asset purchase. Leads neatly to the financing activities, cash movement involving lenders and owners, including the cash inflow from the loan. This statement reconciles the accrual-based world of performance and position to the actual cash movement. These three statements operate as a single living system. The performance story flows into retained earnings. The position story updates based on performance, and then the cash story reconciles accrual outcomes to real liquidity movement. Together, they form the three-statement model, the structured backbone of financial analysis, forecasting, valuation, and stewardship. This integrated view is presented on a single executive overview page, providing a single command view of the business. When we look at the broader landscape, my experience over the decades has shown me that while every business feels unique, one pattern remains remarkably consistent. Of course, companies come in all shapes and sizes. You see differences in complexity, ownership structure, and growth stages, as well as varying levels of operational maturity. In addition, the operational models themselves vary widely. For instance, you may have a lean founder-led business operating with a single legal entity and a small leadership team. Conversely, you have those on the other side of the spectrum that are international groups managing multiple subsidiaries across various jurisdictions. Some are capital-light services business, others are asset-heavy, operationally intensive platforms. Irrespective of how they come, here is what I've noted. Whether I'm working with an early-stage scale-up, PE-backed entity, or steady-state operator focused on optimization, I have found that while the content changes along with the capital structure, the pace and reporting pressure and destination is always the same. What does not change, regardless of the sector or the scale, is the why behind the reporting. And whenever you have sponsorship in the form of outside investment, whether that is the venture capital, private equity institution, or the public market, the day-to-day strategy objective might differ, but the underlying ambition remains absolutely consistent, and that is to do with the maximization of value. In a private equity scale-up, for example, that ambition for value is often pursued through aggressive acquisition. You see multiple companies brought into a group structure. Their trial balances integrated, and suddenly the scale of the business then shifts. Revenue expands, operating cost grows, and the balance sheet swells. But it is important to recognize that these environments, scale is often achieved structurally long before it's achieved operationally. Depending on the deal structure, the group begins to carry new weights. You might have a leveraged buyout LBO for short, private equity management fees, or strict covenant obligations tied to the debt facility. In addition, there are often incentive structures linked to specific growth thresholds. These elements introduce layers that aren't present in a typical business: interest expense, administrative fees, and constant compliance pressure. Now, when the anticipated revenue growth materializes, the structure performs exactly as desired. But when it doesn't, the strain appears quickly. Debt servicing remains fixed, covenants tighten, and liquidity become incredibly sensitive. It is at that exact point where general reporting isn't enough. Operational clarity becomes critical. Ultimately, strong private equity outcomes are driven by disciplined execution. You're looking for that immediate identification of duplicated overheads and the integration of shared services and the protection, or better yet, the enhancement of revenue synergies. The goal is to improve the utilization of your cost of sales drivers so that you can then expand those contribution margins. When revenue increases without proportional rise in direct cost, those incremental gains flow straight into the operating profit, and most importantly, all the way down to the free cash flow. In this environment, free cash flow isn't a theoretical concept. It is the engine that underpins deleveraging, dividend recapitalization, and your eventual exit valuation. But to quantify the real impact of that transformation, your underlying drivers must be structured and modeled coherently. When you isolate and connect these drivers across your revenue, overhead, working capital, and financing, the transformation becomes visible. You can see exactly what is improving your margin, what is de-risking your leverage, and what is strengthening your covenant headroom. Without a driver-based structure, your reports might still balance, but you lose precision. Integration becomes harder to measure, synergies are difficult to validate, and the transformation itself becomes impossible to quantify rigorously. When those drivers are properly collated into a fully integrated model, every strategic decision becomes traceable across performance, position, and cash. In a leverage environment, that level of traceability isn't just a preference, it is a structural requirement. Now, it is important to understand that a driver-based fully integrated model functions more than just a reporting tool. In reality, it acts as the bridge between your operational mechanics and your financial outcomes. Across various assignments, I often see what is a top-down model. This is the commonplace setup where you simply take the trend of the last, say, 3 years, apply a flat growth percentage to the top line, the middle line, and then perhaps adjust depreciation or finance costs as an afterthought. From there, something is spun off to create the balance sheet and the cash flow. That is the simplest part of the entire exercise. The real challenge typically emerges during the monthly commercial review, because those models lack depth. The variance analysis therefore becomes a significant hurdle, leading to endless hours of manual work, version control chaos that is just something that is not ready for the board meeting. The underpinning problem with this top-down trend-based approach is the assumption that history will repeat itself with a slight variation. It mistakes correlation for the actual causation of the financial performance. This is exactly what drives those version control nightmares and lengthy hours before board meetings. Every CFO who's lived through this particular pain knows this pain. It resonates because it's the symptom of a model that doesn't actually understand the business. In a driver-based methodology, we replace that guesswork with unified architecture. We connect structured inputs and processing logic directly to balanced outputs. We aren't just projecting numbers, we are reflecting the actual business drivers that create them. Because the model is nested and fully integrated, it preserves the double entry integrity at every level. If you change a single operational driver, now whether this is to do with the start date, the salary rate, or whatever, or utilization rate, you see the ripple effect immediately. You see the impact on the P&L and then the balance sheet and cash flow. The result is more than just visibility of numbers, it is the visibility of costs and effect. It transforms the finance function from a backward-looking scorekeeper into a forward-looking decision-making operating system. In a buy and build transformation, my role as an architect is to move the organization away from fragmented retrospective reporting and then towards a unified simulation environment. The process begins by stacking the drivers of all the acquired entities into a centralized structured output layer. Here, we aren't just consolidating static numbers, we are aligning the operational DNA of the entire group. Once these drivers are interpreted, the model then generates a comprehensive 5-year outlook of the principal financial statements. This provides the baseline, the clinical reality of the business as it exists today. However, the real power of this architecture is evidenced in the Transformation Impact Report, TIR. This is where we transition from static forecasting to active value creation. Within the input models, we can simulate the heavy lifting required by the PE mandate, reduction in force, ROIF, quantifying the immediate margin impact of overhead rationalization, revenue synergies, simulating cross-selling and price volume optimization across newly integrated group footprints. The TR represents the before and the after with clinical precision. At this stage, if the simulation reveals a funding gap to reach the next milestone, the board is no longer guessing. Any requirement for, say, something like the further injection of equity or a new debt facility or a convertible note becomes a conscious, corroborated decision. Here, we aren't just hoping that the strategy works. We are justifying the capital structure based on the physics of the model. This traceability ensures that every strategic move and every penny of invested capital is backed by defensible, driver-based narrative. In a leverage environment, this isn't just FP&A, it is risk management at the highest level. In a private equity environment, the three-statement model has to be more than just reporting. It has to stand up to the rigors of the transaction cycle. And this is where we bridge the gap between day-to-day operations and the specific deal spec that governs the investment. We start with the valuation foundation, QOE adjusted EBITDA and the bridge. Everything starts with the bridge, that visual and mathematical reconciliation from one state to another. Whether you're working from budget to actual or strategy to adjusted EBITDA, the model makes the logic traceable. By doing so, we prepare the business for a quality of earnings QOE review. We provide a rigorous assessment of where the company's profit actually comes from, ensuring it is repeatable, sustainable, and clean for whenever the auditors or exit buyers arrive. Capital structure LBO mechanics and the cash waterfall. Because a buy and build is often a leverage buyout LBO, the model must be hypersensitive to the acquisition structure where significant debt is used. This therefore places a premium on the model's ability to track debt servicing capacity with clinical precision. We track cash waterfall to manage the priority of payments, ensuring mandatory debt is cleared before any cash reaches the equity holders. By therefore connecting operational drivers directly to the waterfall, we can simulate exactly how a 5% dip in revenue or a delay in synergy realization impacts the cash available to service the LBO structure. Risk management, covenants and headrooms. Perhaps most critically, the model models the covenants. Those financial guardrails like leverage ratio or interest coverage set by lenders that the business must not breach. So here's the thing. We don't just report on whether we passed or failed a covenant this month. No, that's not the purpose here. Use the 5-year outlook to forecast headroom under various downside scenarios. If, for example, the model shows that there is guardrail tightening 12 months from now, the board has time to act whether there is the acceleration of cost reduction program or negotiating terms before the breach occurs. In a leverage environment, this foresight is the difference between maintaining control and entering a crisis. All in all, we've discussed the philosophy of institutionalizing FP&A, the economic essence of the three statements, and the structural pressure of the P lifecycle. But expertise is only as good as its execution. As your FP&A professional, be it as the director, the VP, the FP&A lead, or any other tag you ascribe, my goal is to move the organization from the chaos of reporting on the instability to the clarity of a driver-based operating system. My delivery is built for the pace of modern investment cycles and the demands of a high-level leadership. Whether in a retainer, fixed-term contract, fractional, interim, or transformation-led capacity, I focus on the following: strategic leadership, operating as a high-level partner to the CFO, CEO, the board, translating complex multi-entity data into actionable boardroom-ready narratives. Team transformation, mentoring and upskilling existing finance functions, moving your team from data processor to proactive commercial advisors. Rapid deployment, standing up driver-based FP&A frameworks in weeks, not months, creating a single source of truth for the entire organization. Full FP&A cycle ownership, taking the lead on budgeting, forecasting, and the rigorous scenario modeling required to navigate structural change or turnaround. Now, whether you're leading a fast-paced moving VC-backed company or a mid-sized PE initiative pursuing synergy and free cash flow optimization, or a complex PLC navigating structural change, the next step is practical. I propose a proof of value using your actual data. I'll construct a version of your own driver business test suite or full integrated model that output into the principal financial statements that are the P&L, the balance sheet, and the cash flow. And then these in turn generate your own structured management reporting package. Hopefully, the narrative leads to further engagement. The first step is simple. Reach out. Let's build something exceptional together that is structurally sound, commercially intelligent, and operationally aligned. For now, and until the very next time, happy financial planning and analyzing your companies. Thank you very much.